Every trading day, the market gives value investors a list most people do not even want to touch. The daily losers list is where panic, forced selling, and short-term noise show up first. Most people see a stock down 10 or 15% and assume the story is over. Sometimes it is. But sometimes price moves a lot faster than the business itself. And that gap can create real contrarian opportunity. The goal is not to buy every stock that drops. The goal is to go where fear is concentrated, and then apply discipline. Daily losers matter because they push more companies into valuation ranges that serious investors actually want to study. When prices fall, the potential discount gets bigger. But lower price alone is never enough. You still need to know if the business is durable, solvent, and temporarily mispriced. My first filter is simple. Did the market reprice the stock because the business is actually getting worse, or because sentiment moved faster than fundamentals? I check balance sheet strength, earnings history, leverage, cash generation, and valuation multiples. If the company just missed a quarter, but the long-term economics still look solid, that deserves a closer look. If it is overleveraged, burning cash, or hiding behind adjusted metrics, I move on fast. For a practical screen, I focus on a few core questions. Is the price-to-earnings ratio reasonable against normalized earnings? Is price-to-book giving you real asset support or just accounting noise? Is debt low enough that one rough year does not become a solvency problem? Has free cash flow held up? And most important, does management still have a credible path to compounding value once the panic fades? That process helps you avoid confusing a cheap stock with a good stock. This is where Terminal Investor becomes useful. Instead of manually checking hundreds of fallen names, the platform screens the market, flags the biggest losers that still pass Graham and Buffett-style filters, and turns them into a ranked research queue. You get a fast read on valuation, financial strength, risk signals, and why a stock may deserve a deeper look. The goal is not to automate conviction. It is to automate the first layer of discipline. A good contrarian process starts with evidence. The report format matters because it forces the same checklist every time. Valuation, balance sheet, earnings stability, risk factors, and a clear value trap assessment. That makes it harder to talk yourself into a weak business just because the chart looks tempting. If a stock drops hard and still clears the quality bar, it moves up your list. If it fails on leverage, cash flow, or deteriorating fundamentals, it gets rejected quickly. The real edge here is consistency. Most retail investors bounce between headlines, message boards, and price charts. A better habit is to review yesterday's losers with a repeatable filter before the market opens. You are not trying to predict every rebound. You are building a short list of businesses where fear may have created a mispricing. That is slower than hype, but it is much closer to how real value investing actually works. If you want to apply this process yourself, start with the sample report and then run the screen on today's losers. You will see pretty quickly whether the drop looks like an opportunity or a warning sign. The free trial gives you the same workflow: ranked names, structured reports, and a faster path from red market screens to informed research. If it helps you avoid one bad idea or uncover one overlooked opportunity, it pays for itself many times over.